Thank you, Mr. Fisher, for joining us this morning.
Thank you.
You saw the latest numbers. Obviously, first quarter GDP, old news, but economists think that carried over, that lack of momentum, into the second quarter. And yet we got a pretty good durables report today. CapEx spending is up. So it's a really mixed picture. Where do you see the economy going?
Well, I'm in agreement, by the way, with the way the chairman expressed our expectations. And I think the lead-in's a little misleading. There's not a lot of dissent within the committee. The chairman does an excellent job of summarizing what the committee is feeling as a whole. We expect the pace of economic recovery to pick up in the second half. The question is it a sufficient enough pace to create the number of jobs that we need to create in this country, because we have that deep hole of unemployment. And I think it's going to take quite some time to achieve a glide path that brings unemployment down significantly. So I don't disagree one bit with the way the chairman characterized the economy. Well, it's going to take some time. It's a slow recovery, and it's going to continue to be slow, even though I expect, and we all expect, and I'm in that group that expects it, to see a pickup in the second half.
You marked down as a group your expectations for growth in 2012, sure. And the reading after the chairman's news conference was that he was uncertain about the factors influencing growth going forward and whether those headwinds would go away. Are you as uncertain as he seemed to be?
Well, I think he was just being honest, again, reflecting the consensus of the group as well as his own opinion. But we will have to see. There's a lot at play right now. We have the situation in Europe. We have this headbutting taking place amongst politicians in Washington as to how to resolve the budget issues and what's going to happen with the debt ceiling. We have a slowdown in apparent economic growth, even though it's still rather robust in China and elsewhere. And we have uncertainties that are besetting the business community in terms of their intentions to hire. The one thing we do not have is a lack of liquidity in the system, or the cost of money being too high. That's our responsibility. The FOMC under Chairman Bernanke's leadership has brought the cost of money down. There's a lot of liquidity out there. The question is, how will it be harnessed, and will it be harnessed to create jobs in America? And that's up to the incentives that are provided by the fiscal authorities.
Well, you said earlier this month the Fed has done enough.
I believe that.
And so you're still a solid vote against any kind of additional stimulus, a QE3?
I don't think adding more liquidity is the issue here. There's plenty of it. We have it in excess bank reserves. We have it in non-depository financial institutions. Corporations have an enormous amount of working capital on their balance sheets. I just asked the question, adding more, what would it do? It might give rise to fears that we have sort of either set in place future inflationary forces or are becoming more politically accommodative, which we are not, by the way. I have yet to hear one person at the Open Market Committee in my 6 years of being on that committee be politically compliant. That's not the way we operate. The way we operate is to try to get it right for the economy.
Well, you say there's not a lot of dissent on the Fed, but you are joined by others in saying you don't think we need additional stimulus. How divided are the policymakers over the need for stimulus? Is that a concern for financial markets?
It depends on what the financial markets' assumptions are. We had what you refer to as QE2, we refer to as long-term asset purchases. That program is over. We said it would end at the end of June. It's ending at the end of June. And now we'll have to see how things proceed. But I think we've telegraphed our intentions very clearly. Again, I was against that program to begin with, but that's not the point. The point is the program's over now. And yet, if you look at what happened in terms of the two-year bill or note yesterday and where interest rates are presently, we have pretty strong fixed income markets. And the equity market was quite volatile yesterday. I wouldn't read a lot into one day's movement. But I think the market's been able to discount our intention.
Well, are you constrained as an organization, as a group, by differences? In other words, if there is a need for something else, could you come together, or at this point are you too divided on additional stimulus?
I don't think this business of dissent is a healthy conversation. There are differences of views. Every view is listened to. These are expressed by thoughtful people who are doing their very level best to try to get it right. There's an enormous amount of burden on each of our shoulders to try to give the best advice that we possibly can. And we'll continue those discussions under the chairman's leadership.
So at this point, nothing additional coming.
At this point, what is coming and is clear, as said by the chairman in his press conference, as said in our statement that we released after the meeting, is that this recent round of monetary accommodation, the $600 billion program, ends at the end of June. That much is clear. Also, that we would continue to reinvest the roll-offs.
For how long?
For as long as is appropriate. How's that?
Would you attach the extended period?
That'll stay in place as long as it's appropriate. You know, again, we have to see how things develop here. We have to see what happens on the price front, and also on the employment front. We have a dual mandate. But the question is, would adding more do much more? Would adding more liquidity do much more? Would bringing rates down even further do much more? Again, the 2-year note is within 4 basis points of an all-time low. Money can't get much cheaper than it currently is.
Well, Mr. Fisher, just before the break, we were talking about the fact that the economy is still finding its legs, still not using all the liquidity you've provided. But at some point, that will come. Mm-hmm. When that time happens, how would you see the Fed withdrawing it? Would you first want to sell assets or first want to raise interest rates?
This question of sequencing is constantly being discussed. No final decision has been made here. But we have a lot of tools to use. We can raise the base rate. We can sell off some of our assets. When you sell something, you take money out of the system. We have, of course, the interest on excess reserves that we can also use as an adjustment tool. So we have a greater toolkit than we've had before. We've never been in this circumstance before. A lot of sensitivity testing has been taking place, and a lot of thought has been put into this process. I want to come back to a point I made in an earlier discussion with you, which is I'll be delighted when we get to that point. I'd like to see this excess liquidity, this amount of liquidity, get transmitted in the economy into job creation. And I very much look forward to an exit when it's appropriate, but it has to be an appropriate time. Mm-hmm. Right now, the economy is weak. We've stopped additional purchases of long-term assets, and we'll have to see how that's digested by the economy before we talk about how we remove and reduce our balance sheet and remove the stimulus that's provided the economy. I want to see that stimulus first. Yeah. That would be a happy circumstance for me. And we are devoted, absolutely, to making sure that we don't give rise to sustainable inflationary pressures that could be destructive. That there is no disagreement whatsoever.
Do you want an inflation target?
Personally, I would be quite pleased with having greater specificity on inflation. It's widely assumed, correctly assumed, that our tolerance for inflation of greater than 2% does not exist. We don't want to see that on a sustained basis within the economy. So
is 2% your number?
I happen to be a little bit more hawkish than some of my colleagues, but this is a committee, and the committee has to make a decision. I would be very happy if we had an inflation target, but again, there's a question of timing. Right now we have a dual mandate. We do get that direction from Congress, and we'll have to see what obtains.
New survey by Bloomberg out this morning shows Ben Bernanke's popularity with the public has fallen precipitously. Only 30% think he's doing a good job. Do you think that's fair?
I don't care. We're not in this business to be popular. We're in this business to be central bankers. I know Ben Bernanke extremely well. There's not a bone of pretension in that man's body. There is 100% sincerity in that man's body. And he's just doing the best he can as our leader. This is not a one-man show. This is a committee. It's a federal open market committee. There are 17 of us in that group. All of us do the best we can. Fortunately, we're not politicians. We're just assigned a job. And whether it makes us popular or unpopular is not the issue. The issue is, do we get it right? Paul Volcker was despised by the American public. Today, viewed as one of the giants of all time, probably the most reputable former central banker and the greatest living public servant. You don't know how much hatred there was for Paul Volcker at the time. So you don't do this job to be popular. If you do, you don't get into the business.
Does it make it more difficult? I've got 30 seconds left. Does it make it more difficult for the Fed to do its job if the public is questioning whether you're doing the right thing?
I think the most important thing is the results of what we do. And we're not in the popularity business. It's nice to be loved, but the most important thing, we will be loved if we get it right, and we're doing our best to get it right.
All right. Richard Fisher, thank you very much for joining us this morning. Richard Fisher, the president of the Dallas Federal Reserve Bank.